All right. Today is Sunday, the 2nd of February. This is a recap for the stock market activities for the week that was and an outlook for the week to come. Now, folks, I got a good one for you tonight. What a week, what a week, what a week it was. And before I get too excited, please pull your pants back up. It's kind of too early in the show to drop them down and start jerking off. Hold your horses a little bit. And by the way, close that nasty tab you got open on incognito while you're listening to my show. It's kind of disgusting. But folks, we got an important show because we have a lot of development that took place throughout the week and specifically over the weekend with severe impacts on both the economy and the market. Now, we're going to go over, of course, spoiler alert, DeepSeek, the trade war, the Federal Reserve decision, what's going to happen in the stock market, what's going to happen to the economy because of the tariffs and all of that. Then we're going to talk about the big scores that we've made trading all of this insanity. If you're in my Discord, it was a good day Friday. It was a good week, to be honest with you. So we'll cover all of that, but let's begin right away with, we start the week, chaos right away, fear right away, NVIDIA, the poster boy of the bubble. And according to the experts, you can't bet against NVIDIA. You're going to get crushed, bruh. It's going to go to 20 trillion, 50 trillion, just throw numbers out there. Well, guess what? We open Monday and NVIDIA loses over $600 billion worth of value in a single day. The biggest crash in stock market history. But of course, rest assured that you should have watched the Nancy Pelosi portfolio update because she kind of knew what's going to happen and she exited exactly at the top before the crash. Now, the bigger question that everybody's been talking about throughout the week, what is the deal with DeepSeek? Is it legit? Is it not legit? And why is it threatening to pop the bubble, and why is it threatening the market and specifically a stock like NVIDIA? And the short answer to that is we made a video in this channel about a year ago talking about Y2K and the similarities between the dot-com bust and the AI bubble that we got right now. And in a nutshell, I said, look, all bubbles act and react the same way. And what's going to pop the bubble in NVIDIA and the AI mania is the loss of pricing power by NVIDIA. I don't know how, I don't know when, but all I know is the moment when we see NVIDIA losing the pricing power, meaning selling these chips for 80 grand a piece, when it cost them a fraction of that to make it, because there's a bunch of lunatics running the big cap technology companies with deep pockets, and they're just stampeding and hoarding chips that they don't know what to do with. Once that narrative is over, you begin to see the end of the bubble. And what DeepSeek did is, hey, you don't need to really spend that much money on NVIDIA chips anymore. You want to develop the bullshit generative AI, which is a gimmick, by the way. You always had some sort of generative AI. Why are we fluffing up a $30 trillion worth of a bubble? Because we got some cute tool that can summarize your searches in Google and give you some answers. 50% of them are wrong. But of course, they all have the sheep mentality and they keep hoarding these chips because just in case. We'll be ahead of the other company. Meta says we're going to be ahead of Microsoft. Microsoft, we're going to be ahead of Amazon. It goes as a sort of a stupid, cheap kind of battle. But who's going to hoard more? Once you pierce that narrative, it's over. And DeepSeek is that pin that kind of pierced the narrative. DeepSeek says you don't need to spend any more on NVIDIA chips. You can achieve the same or even better results with a fraction of the cost and the concentration of software, not on the hardware. You can achieve the same, if not even better results with non-so-advanced chips, aka the cheap chips. And that's pretty much the beginning of the end of the bubble, when everybody begins to question the narrative. But if that was not a convincing reason for you to understand why NVIDIA went down and the threat of DeepSeek, there is another explanation. I think it all went downhill when Jensen Huang, the CEO of NVIDIA, came here in Las Vegas in the SEC conference, and he forgot to sign titties. That's when it all went downhill. So for the sake of the global economy, the sake of humanity, we're going to invite Mr. Huang once again back in Vegas to the finest strip clubs that we have here and have him sign a bunch of titties. That should save the market and the economy. But to me, the biggest beauty of DeepSeek is the fact that it challenges and perhaps makes ChatGPT obsolete. And in essence, it makes this snake Sam Altman. You got to watch out for this guy. Oh, he's just the tech nerd from San Francisco. He's harmless. But wait till he takes his mask off, because this lizard is the enemy of humanity. If we keep this guy going, next thing you know, we're going to get nuked by AI. So at least there is a challenge in the narrative, and I think that's the best thing that came out of DeepSeek. It made this piece of shit irrelevant. Just in time when he broke his promise of keeping ChatGPT non-profit, all of a sudden he's looking to make billions of dollars by dumping this gimmick on the stock market for probably a valuation of over $500 billion. not even $1 trillion, to scam the mom and pop investors and the retirees and the pension funds. Well, DeepSeek says you're in deep shit now. But speaking of lizards, folks, Mark Zuckerberg of Facebook came out with scrambling a war room of engineers to figure out how he's going to challenge DeepSeek AI. And how did they do it for a fraction of the price? Maybe because they're not concentrating on the stupid classes that you got. And I said throughout the week, by the way, I said that DeepSeek is bad for NVIDIA. It's bad for some of the stocks that caught a bid because, we're going to see demand for NVIDIA chips and other chips. And we see, for example, demand for electricity and energy and data centers and memory chips and all of that. It hurts all of that assumption. But it might actually be good for the big cap technology stocks, like Meta, like Amazon, like Microsoft, because now they don't have to spend as much as we thought, since you don't need the NVIDIA advanced chips for 80 grand a pop, 100 grand a pop. But again, they bought the narrative and they're so deep in it that the DeepSeek comes as a massive shock. And they still don't recognize what happened, that, hey, the game changed now. So you still got Lizard Zucchiniberg, who's a disgusting individual, by the way. It's absolutely pathetic. All of the kiss ass that he's doing with Trump and trying to play the alpha male, UFC. You're not fooling anybody, Mark. We all know you're a beta male. But of course, he wants to say, look, I can spend as much as Microsoft. I'm spending all of these billions and billions of dollars, and I'm important. I'm going to be the head of AI, whatever. It's all about ego and stupidity. They have more chips than they know what to do with. And most of this AI hype that they're doing is not going to come to pass, at least not in the immediate term. So just when you thought that there was a silver lining from the DeepSeek introduction, which is, hey, the big caps not going to be needing to spend as much as we thought before, and that means that their stocks will go higher, and that should be a net positive for the stock market. Sure, we lose NVIDIA, but the rest of them should go higher. But they're insane, of course, because they're still deep in buying that stupid narrative. So Meta reports earnings, and they come out and say, we're going to increase CapEx to buy all of these chips and all this stuff, AI spending. CapEx is going to go 59% higher year on year. And you just need to look at this. We did the earnings reviews video, by the way, for the members in the channel during the week. And I explained this. In 22, CapEx increased 67% year on year in Meta, but the net income growth down 38% year on year. That's a recipe for disaster. And that's why the stock crashed. It crashed in anticipation of this result. The stock market is always ahead. So when it drops NVIDIA 16-17% of the day, you got to think, what is the message by the stock market? Then comes, of course, 23, and they reduce the spending, they increase net income growth, and all of a sudden the stock bottoms and begins to thrive again. Similar story in 24. The growth rate of CapEx, short of the growth rate in net income, all good. That's what we need to see. But if you're going to increase CapEx in 25 to 59%, where do you think the growth in net income is going to be? 69%, 70%? Doubt it, because the trend is down. You increase CapEx, you're going to reduce the net income growth and have a deficit again, which means the stock is going to go down. And there is a reason why Meta management did not disclose the projection for revenue or net income, because had they let that information out, the stock would have crashed right away. But we see the same problem with Microsoft, by the way. Microsoft is even spending more than Meta, like a drunken sailor. They want to spend almost $90 billion this year alone. Well, gee, what is the net income growth for Microsoft? Yeah, it is declining. What do you think that's going to do to the stock? I wonder why it went down by 7% for the week. So unless these companies begin to get the memo that you don't need to spend as much, what's going to happen is we already popped NVIDIA. Now we're popping the big caps. And we're going to talk about the tariffs in a minute. That's going to pop other things in the market. Well, that's a bad recipe for both the market and the economy, because you got to understand one thing. We talk about how consumers are getting weaker and credit card debt is moving higher and delinquency rates are going higher. And we talk about all of that all the time. But the question is, why isn't the economy in a recession already? If we have all of this weak data similar to 2007, 2008, the short answer is we're not in a deep recession because of the stock market bubble. It keeps a certain class of the consumer confident enough to spend in the economy. That usually happens to be the higher-end consumer, the affluent consumer. They have a lot of resources. So what we've been seeing so far is this polarity in the economy, where we have certain folks who are already in a recession, but we have the folks who are depending on the stock market gains to say, yeah, inflation went higher and things are a little tighter, but I feel confident to spend because look at my portfolio. The wealth effect. If this introduction of DeepSeek drops NVIDIA and the big caps, with it, of course, the indices going down and the stock market goes down, you're going to eliminate that confidence and that wealth effect to a point where the consumer stops spending in the economy. That's, of course, going to introduce the recession risk. You got to remember, in this channel, we've been talking for over a year now, since this whole game began. It's going to end up in a crash and a recession because of a simple concept. And that is when you let inflation go, as high as it did. You can play the game of, oh, we're going to do soft landing and maintain inflation at whatever percent and all of that. And you can have a limited degree of success, as the Fed did, of course. But at the end of the day, you're going to get knocked out. We talked about the analogy, walking the tightrope. You got wind hitting you from the left and the right. From the left, recession. From the right, inflation. One of them will knock the economy off the tightrope. And if you drop the stock market, as you've seen in the beginning of the week, you're increasing the risk of a recession and you're reducing the risk of inflation. And you could see that evident from the reaction to the bond market. Bonds actually rallied in the beginning of the week. Bond yields were down. As to say, you know what, maybe the recession risk is going to be more dominant as the stock market goes down. We see consumer spending coming down because of it. Then the Fed maybe needs to cut rates even more. That was the assumption at the beginning of the week. Here's the problem, though. The market can tolerate the emergence of one risk because the Fed always has the other tool to balance it. So if you have the recession risk, for example, becoming dominant, well, the Fed can cut rates and mitigate some of that. If you have the inflation risk becoming dominant again, then the Federal Reserve has the ability to raise rates and balance things out. Of course, the Federal Reserve would rather have a recession risk because cutting rates is easy and has been proven to stimulate out of recession. Inflation risk, if you begin to hike rates to eliminate the inflation risk, you end up tightening the economy and hurting it and increasing the recession risk in the long run. This is why the Fed has been really careful. They don't want the inflation risk to be dominant. They're okay with the recession risk, not the inflation risk. But the problem is, folks, when you have both of these wins, both of these risks hitting at the same time, we just talked about the recession risk, which is if you drop certain number of stocks, the heavyweights, you drop the market, and that's going to have an impact on the economy, a recessionary impact. At the same time, by the end of the week, we have introduced the inflation risk once again. How did that happen? Well, we got Friday's session at least began okay. The market was going higher. Why? Because we got the headline from fake news Reuters, always with the fake news. They say exclusive. Trump set to impose tariffs on Mexico, Canada starting on March 1, not February 1. Everybody was nervous that it's going to happen over the weekend. Reuters came out and say, no. According to sources familiar with the matter, the Trump administration is going to do it March 1st, not February. So we can kick the can down the road and push the market higher. What do you know? Every time they say people familiar with the matter, that means it's fake news. It's bullshit. Even though market participants, when asked, this is why we've seen a huge negative reaction on Friday and an increase in volatility. When asked, will any formal tariffs be announced by February 1st? Of course, everybody's complacent, so the majority said no. Well, guess what? A few minutes later, we got the real news. And the real news says, no, he's going to impose tariff over the weekend. And over the weekend, indeed, we got the headline. Trump slaps tariffs on Mexico, Canada, and China. And the details, 25% tariffs on Canada, but 10% on Canadian crude. We'll explain that in a minute. 25% on Mexico and 10% on China. Now, I thought it was a pussy move by the Trump administration to keep it at 10% for Canadian crude. If you want to go the distance, just go full blast. We're already going to have damage, might as well have it all at once. But maybe the Trump administration is using this as a negotiation card, which is, hey, Canada, if you retaliate or if you don't cooperate, we're going to jack those crude oil tariffs from 10% to 25% too. The problem is it's going to hurt us big time. Why? Look at the chart that I'm showing you right now. U.S. crude imports from Canada been steadily increasing. Big market share of the total consumption of crude imports, meaning that if you're going to tariff Canadian crude, then it's going to result on expensive pricing on the U.S. consumer, which will lead to higher inflation. And this is why we've seen crude oil futures moving higher on Friday after the announcement of, the tariffs are going to happen over the weekend. And last time I checked before recording this program, the futures, crude oil futures, are still higher. They're moving higher because of this threat. Which region will be impacted the most? The Midwest? Look at the crude imports from Canada into the Midwest. Of course, we began reducing Russian imports, relying more on Saudi imports, relying more on Canadian imports. So there will be devastation against the consumer. And mind you, the Midwest, of course, voted for Trump, and it was the key for him to win the elections. And this is why he's starting with a 10. But he might retaliate again and increase that to 25. And that's going to have a huge impact, inflationary impact, I should say, on the economy. It's also going to get more expensive for refiners for importing Canadian crude and mixing it up with the light crude that we have here and producing gasoline. How do you suppose the refiners will make up for that increase in cost? They got to pass it down to the consumer. meaning that gasoline RBOB futures will continue to move higher, resulting in higher prices at the pump. And I know folks been dismissing that, oh, he's just bluffing, he's just negotiating. Sure, maybe. But I think this guy it's part of we talked about the Trump economic paradox. It's part of his dogma that tariffs are good. It's not just because of the trade deficit or whatever. Tariffs by nature are good. So this is Herbert Hoover 2.0, right? We're going to have the Great Depression next because tariffs is not a good policy. But in the Trumponomics, he believes that tariffs were and should be again a source of revenue for the U.S. government because that allows you to reduce taxes, that allows you to do other things. Not to mention, of course, incentivizing producers to produce here in the U.S. with U.S. labor. So we talked about that there is method to the madness. But at the end of the day, is it going to be practical? Do the numbers really add up or not? That's the challenge in implementing such policy. The problem is the trade war is now heating up because immediately after the tariffs that we announced against Canada, they came out saying that they're going to detail retaliation plans to the U.S. tariffs that will seek to hurt Republican states the most. Of course, some Republicans disagree, and I'm in that camp, by the way. I'm saying that tariffs are never a good policy. It's an increase in taxation on the consumer. But again, we can make arguments about NAFTA and loss of jobs and all of that. So there are both sides of the argument. But listen to Rand Paul, Republican, says tariffs are simply taxes. Conservatives, once united against new taxes, taxing trade will mean less trade and higher prices. In Trumponomics, he knows that, but he thinks that it is a price worth paying. And oh, by the way, we can mitigate the damage from tariffs by reducing taxes and forcing the Fed to reduce rates. Sounds crazy? Sure, but that's what he believes. Well, gee, next thing you know, Canadian Prime Minister Cocteau, he came out and imposing 25% tariffs on $155 billion worth of American goods. The Canadians are being tough now. Oh, flexing your little muscles here. But you know what? I think it's time. It's about time to see a USA-Canada spat. I think it's about time to fuck with Canada, just for fun. Because outside of hockey, we haven't seen a Canada-USA rivalry since Bret Hart in the WWE.
Did you ever notice the United States of America is shaped like one big giant toilet bowl?
And here it is. Canada shot their shot, retaliating, acting tough. Here comes the Trump administration saying if Canada retaliates to our 25% tariffs, we will double them. That's tough talk. That's the kind of talk that's going to scare the market. You double the tariffs to 50%, that's going to be disastrous. And what happened to the crude imports? Does that go from 10 to 25? Maybe 50? That's the uncertainty that the market doesn't like. Negotiating tool or not, it's going to cause chaos. And now, of course, Canada is collaborating with Mexico. And you got Prime Minister Cocteau. He says now is the time to choose products made right here in Canada. So don't buy American products. And Mexico is now, of course, retaliating against the tariffs as well. And just in, China came out and saying that they're going to retaliate against the new tariffs by President Trump. Here we go. Here we go. And on top of that, we haven't forgotten about Europe, of course. He has the biggest hard-on against Europe. It ain't China, it ain't Canada to a certain extent because he doesn't like the prime minister, but I think he's more lenient on China and Mexico and maybe Canada in the future because the prime minister is not going to stay there forever. I think he resigned already, but he has a hard-on against Europe. And I said in the program before, the most devastating tariffs will be against the European Union. And guess what? The EU came out saying that they're going to respond firmly if Trump imposes tariffs. This is a full-blown trade war. And we're not even, 1 month in? He wasn't bluffing. And unfortunately for market participants and these zombie asset managers, they're all complacent. They're all caught off guard by 2 hits this week, DeepSeek and the tariffs. Let's discuss a little bit the economic impact from the trade war. How much trade is at stake? China, Mexico, and Canada account for roughly 40% of U.S. imports, worth more than $1.3 trillion. According to the Council of Foreign Relations, the U.S. imported $529 billion in goods and services from Mexico, $482 billion from Canada, and $448 billion from China in the year 2023. All in all, the U.S. imported $3.2 trillion worth of goods. So we're talking about tariffing pretty much 40% of imports, and they're tariffing a huge part of our exports. This is ugly, folks. What sector is most at risk? Short answer is everything, really. But here it is. Energy, autos, and agriculture face some of the biggest hits. Canada supplied 60% of crude oil imports in the U.S. in 23, about 4 million barrels a day. And of course, as we mentioned before, according to the Congressional Research Service, they say that since crude oil is the largest refinery input cost, higher tariffs could immediately reduce refinery profitability. Think it's about, it could be bad for the refiners, got it, but I think it's going to be a good, positive outcome for them in the long run. Why? Because gasoline is a necessity. What are you going to do? Not fill your tank, not do business? It's going to be easier for the refiners to pass the extra cost down to the consumer, even do a little bit of a price gouging on it. On the other hand, the consumer is getting weaker, so who knows? Maybe we're just going to ride donkeys to work. Canada also sells electricity to the U.S. from New England to the Pacific Northwest. The value of power sales from Canada to the U.S. was $3.2 billion in 23, according to the U.S. Energy Information Administration. The auto industry, I think this is the one that's going to get hit really, really hard. The auto industry may have the most to lose. Mexico and Canada have spent decades integrating auto operations with factories near the border for parts and final assembly for vehicles. Thank you to NAFTA, right? We took the good jobs here, shipped them overseas. It made cars cheaper for the consumer, but there's a price to pay. This president feels that he needs to correct the mistake via tariffs. Last year, Mexico supplied the U.S. with nearly 43% of imported motor vehicle parts through November, and Canada sent over 25%. So this is going to be a huge, huge hit for autos, which could, by the way, lead to a sort of a rush by the consumer to buy cars right now because they're going to get more expensive later. So it could be good for the dealers, some of the used cars producers, maybe some of the auto parts stores that folks buy their stuff now rather than later. It could be, a big could. Consumers might feel the sting through price increases for everyday items like food, beer, and gasoline. Mexico accounts for 23% of U.S. agricultural imports, including 63% of vegetable imports and 47% of fruit and nut imports. The U.S. bought more than $3.1 billion worth of avocados and more than $2.7 billion in raspberries, blackberries, strawberries from Mexico last year. So the hipster community will get damaged with the expensive avocados. Anyhow, along with the ubiquitous avocados and berries, Mexico is a major supplier of imported beers and spirits like tequila. So if you hit the clubs and your trick is to get the chicks drunk, drink a tequila, that's the best, of course, and then get them back to your place, you gotta find another trick here. It's gonna cost you more, not to mention, of course, might end up in jail. Anyways, meat and whiskey could get more expensive. Rest in peace, Joe Rogan. He actually can't afford it, right? So never mind. But for the rest of us, the brokies, we purchased north of $3 billion in beef and pork products from Canada. And of course, Canadian whiskey would be pricier. Anybody really cares about Canadian whiskey? Not really. But you might care about other items, surprising items. This is from the journal right here. They say these items might surprise you. And they talk about cherry tomatoes. They come from Canada and Mexico, so that's going to cost you a little bit more. Sort of a cherry on top. Then we got Tonka trucks. Those are going to go higher in price. They come from China. Maple syrup. This is the real deal. The real maple syrup comes from Canada or Vermont. If it doesn't come from any of these two places, like the one you go to Denny's, that's somebody's ass juice. It's not really maple syrup. Then you got tequila with all of these dumb celebrities making billions from tequila. Well, that's not going to happen anymore because we got to tariff all of that. Avocados. More than 80% of U.S. avocados come from Mexico. How about smartphones? A lot of them come from China. That's not going to be cool. And then sledgehammers, already 25%. We're going to increase those on sledgehammers. So if you're interested in doing some domestic violence, you got to stick to your fist. I mean, jail and divorce are pricey enough. You don't need to spend on sledgehammers. But here are some of the categories for you. So select imports to the U.S. from Canada in the year 23. You can see crude oil, huge deal, small engine passenger cars, okay, kind of. Natural gas, we do a lot of natural gas here, so the share of imports is about 100%. But it's just a drop in the bucket, so it's going to increase natural gas pricing without a doubt, at least in certain regions. But you got to keep in mind that we produce the majority of nat gas here. Lumber, Canadian lumber, big time, so housing costs will go higher. Hybrid passenger cars, bakery products, and frozen French fries. 81% of U.S. frozen French fry imports come from Canada. But we got Idaho, so that makes up for that. What about Mexico? More reliant on Mexico, to be honest with you, because the Canadian stuff you can substitute with exceptional lumber and crude, but then you look at and some of the auto parts, I mean, it's going to be hard to bring them back. But you look at New Mexico, it's pretty much comes down to food, which the consumer will feel right away. It's going to have an impact on the CPI right away. So sure, small engine passenger cars, who gives a shit? PCs. Didn't know Mexico makes PCs. You got vegetables, TVs, beer, tequila, avocados, tomatoes, raspberries, strawberries. You look at raspberries, 100%, almost 100% worth of the imports come from Mexico, so you're going to see an impact right away. What about the stuff that we get from China? In the year 23, smartphones, laptops, tablets, lithium batteries, toys, video game consoles, all of them will get pricier. Could it cause a rush in buying smartphones or laptops right now before the tariffs? Could be. Toys, all of that is a possibility. So you have to put two and two together here and try to predict what the consumer is going to do, which could lead you to figure out that, okay, this could be actually good for certain stocks or bad for certain stocks. So we try to do that here. And I think the negative impact is going to come for names like Amazon, huge reliance on China, Apple, new iPhones. They say we're going to have a new upgrade cycle. Well, that's going to cost you more now. And the new AI phones are bullshit anyways. Walmart is going to get damaged. One of the stocks that are all-time highs, right? It's been insane. So they be shortable because of this. Why? Because they have to get all of these vegetables from Mexico and fruits, and they cannot really pass the extra cost to the consumer to maintain their value approach. They have to eat it. Elf Beauty already warned us that, hey, if there are tariffs, we're going to get damaged. Mission, that's avocados. Names like TJ Maxx, retail stores with the stuff that comes from China, AB InBev, Diageo. We're talking about Corona. We're talking about tequila. We're talking about a lot of stuff that comes from Mexico. It's going to hurt the Chinese names to a certain extent just by association, like Alibaba, even though Alibaba has no direct business right away to the tariffs. And I think that Alibaba, I'm going to stay bullish in Alibaba because we're going to begin to appreciate the Chinese AI story more. And the valuation of what we have in the U.S. stock market versus the valuations, the attractive valuations that we have in the Chinese market, it makes a bullish case for Chinese AI. But they're going to get damaged by association, at least in the short run. Now we got stuff like Deere, with the tariffs going higher, and they shipped a lot of stuff to Mexico. Bad move by John Deere. Caterpillar would get damaged. A lot of the industrials, to be honest, I'm just giving you examples here. But the majority of industrials would get damaged. Bear in mind that industrials, along with big cap tech and financials, been actually one of the drivers of the stock market going higher. Then you look at the chip cohorts. So you see here chip making, equipment, China exposure, names like AMAT, ASML, Lam Research, huge exposure to China in the year 24. They've been increasing their exposure. NVIDIA, China chip revenue been increasing higher. It was part of the bullish story, and now you got to damage that. Other chip makers, exposure to China, you can see Qualcomm, huge exposure. Marvell, Broadcom, all of them really have exposure to China, so it's going to impact names like Broadcom, ASML, NVIDIA, Qualcomm, all negatively. If you increase the tariffs and reduce the trade volume, then that's going to be bad for the shippers and names like International Paper with packaging and all of that. All the cheap crap that Nike makes out of China, that's going to be more expensive. And of course, because of the Canadian tariffs, all of the EVs, all of the automobiles like GM, Ford, Tesla will get damaged tremendously. The Chinese EVs, of course, like NIO, will be hit too. I like NIO, but there's no escape here. Names like Magna. I own the stock in the portfolio, but I hedged and then some before the beginning of the weekend. That's going to get damaged. That's auto parts. A lot of them come from Canada. And then got names like Lennar, the home builders. With lumber cost going higher, that's now going to cost them more. Not to mention, of course, all the stuff that they got to buy from China or comes out of China. That's going to cost them more. And consumer is not really recipient right now. Consumer is too broke to buy homes. So their input cost increases, but they can't sell the homes. That's a negative for the home builders. What else can be impacted by the trade war? You saw the impact right away on Friday's session. Bond yields went higher, US dollar went higher. Why? Because the assumption by the market is you impose the tariffs, you increase the risk of inflation, which means that the Federal Reserve will have to adapt a tighter policy, leading to perhaps rate hikes. So bond yields go higher, US dollar goes higher, and that's going to impact, in the case of bond yields going higher, it will impact dividend stocks negatively. Think about the staples, think about real estate, think about utilities. It's going to impact value stocks negatively. It's going to impact small caps negatively. It's going to impact something like the equal weight ETF, like the RSP negatively. And of course, bond yields going up, that's probably going to impact financials negatively because there's a limit. Okay, bond yields going higher to a certain extent, good for JP Morgan perhaps. But if rates continue to go higher and surpass the previous highs, then you're going to tighten the loan requirements and the loan generation in the economy. That's going to cause a recessionary impact, reducing the revenues and the profits for a lot of banks. And of course, when we talk about asset managers like Goldman Sachs, if the market goes down, because we just talked about a lot of technology and industrial names, stocks under threat. And then we're talking about, bond yields and the dollar go higher, so Other corners of the market also get hit. Well, that's not going to be good for Goldman Sachs. When the dollar goes higher, it's obviously that it's not good for metals. Not good for gold, even though gold can display a degree of resiliency in the short run. But if the dollar keeps going higher, then gold will at some point capitulate and go down. Dollar going higher, not good for cryptos. Dollar going higher, good for some commodities. That's including energy, maybe some of the softs like coffee, and of course lumber, because it comes out of Canada. But it is negative for metals and grain commodities. Any winners from the tariffs? Maybe. This is a big maybe, question mark. Because what we've seen back when we got the inflation episode in the year 22, a lot of these names performed better because they used the opportunity to pass the extra cost down to the consumer. So the assumption here, and by the way, you might see them down tomorrow. That's okay. But what if they get hit with the tariffs and they use that as an excuse to pass that cost and do some price gouging on top of that to the end consumer? So we're talking about some fertilizers like Mosaic and Nutrien, of course, Canadian companies. So can they pass the extra cost? I mean, at the end of the day, you need fertilizers. It's sort of a necessity. The same goes with Valero and the refiners. Yes, we're going to have a negative impact, but at the end of the day, it's a necessity. What are you going to do? Not buy gas? So they can pass the extra cost down to the consumer. Maybe, again, do some price gouging. We're going to tariff a lot of lithium batteries coming from China, so I think maybe it could benefit domestic producers because it increases the commodity price for lithium. That could be good for a miner like Albemarle or a QuantumScape that produces also lithium batteries here in the US and Canada. So it's not totally immune, but the theory is they can pass the extra cost to the manufacturers. So the manufacturers are at disadvantage. Ford, GM, Tesla, Rivian. And then, of course, the railroads like Union Pacific and Canadian. I'm just giving you an example here that it could be good for the railroads because now with the tariffs, they're going to have to assume an extra cost, maybe a reduction of volume a little bit, and they might use that as an excuse to increase their fares. So that's a big question mark. I'm not saying buy these stocks. I'm just saying it could be good for these stocks. We need to see more clarity in how they're going to manage the tariffs and can they pass the extra cost down to the consumer or not. What is immune from the tariffs right now? It's healthcare and software. And this is why if you look at the Maverick portfolio, we're over-concentrated in healthcare. And I've been an advocate for software since last year. It's the best place to be in technology. And now with DeepSeek highlighting the importance of software development and investment over hardware, such as chips. And on top of that, investors want to look for safety from tariffs, so I think it's going to be a positive for software. Again, no guarantee they're going to open higher tomorrow or throughout the week, because when you drop the ETFs, when you drop the market down, an increased volatility, then everything sells all together because of the algorithms. With that being said, I said on the 30th that we're buying calls on names like Team, the ticker TEAM. That name reported earnings this week, and the stock blasted higher by 19%. So we exercised that, and now we own Team in the portfolio, and I suggested that we buy more software names. But you got to hold your horses and see how the initial hit against the market will look like. If we begin to find some footing, then I think that software, again, should be an attractive place to be when you have tariffs, but you also have DeepSeek as a catalyst. Now, if we tie it all together here, folks, you saw the degree of the damage in the goods and the stocks that will get impacted. Of course, this is a president that's going to go with the tariffs because it's part of his dogma. But this is also a president who's really sensitive to the stock market performance. He sees it as a scorecard. And soon enough, he's going to be under pressure. If the stock market goes down 5, 6, 7, 8, 10%, maybe 20%, he's going to be under heat by both Democrats and Republicans. Wait a minute, is this really the best policy that we can do? Get into a trade war right now? Look at what you've done to the stock market. He's going to deflect the blame to Jay Powell, the chairman of the Fed. And he's already been doing that. The inflation problem is his fault, and he's not cutting rates. So he's going to start pressuring Powell, the Federal Reserve, to cut rates to mitigate the damage in the stock market and the economy coming from the tariffs. Well, Powell, I think we talked about this in the face-off. It's going to be a war between Trump and Powell. Powell is going to blame Trump that, hey, I was doing progress against inflation. You brought up the tariffs, and now you fucked everything up. Trump is going to say, no, the tariffs were okay. We did that back in 2018. Nothing happened. But you are too tight with the policy. This is going to be really interesting, folks. So bring out the popcorn as much as you need before the tariffs. I can't wait for the Trump-Powell fight. It's better than Tyson, really. Here's the problem for Powell. Let's say he wants to play ball. Doesn't want to upset the president. Hey, let's give him some rate cuts so he can stop barking. Well, he can't do that. He cannot really risk inflation going higher. He has to do whatever he needs to do to maintain inflation. And inflation worsened. That's the headline. Worsened. Not getting better. Worsened in December. What it means for the Fed rate cuts, it means that they went kaput. forget about them. And now the tariffs, forget about them, multiplied by 2. We said coming soon, rate hikes. And that's what's going to come. Even without the tariffs, you look at the core PCE, you look at the PCE, both of them look like they're bottoming and they're about to head higher. We got a big fight here ahead of us, folks. And once the White House gets into it against the Fed, that's going to cause massive uncertainty, massive volatility, folks. So, word to the wise, hedge your portfolios. Don't be arrogant. That leads us to the market discussion. You see, these zombified retail traders and investors, they've been spoiled for years, right? Everything, you buy the dip, everything goes higher, stocks go up. Yeah, they could crash by 70% and they come back again. So you got to buy all of the dips. Every time we drop, you got to buy. They don't understand that it's the job of the stock market bubble to suck the excess liquidity and the excess wealth out of the economy and transfer it in the hands of a very selected group. The CEOs, the insiders, the oligarchy. They don't understand that. Because they've never been disciplined, really. The last time we got ahead against the stock market was 2008. You got a lot of examples after that in 18, in 2020, and 22. It just keeps recovering. So they think that's going to be the same tune over and over and over again. They're never really going to see it coming when the music stops. And this is why I think this upcoming crash will be more devastating than anything we've seen before. Maybe not the 1929, but it'll be more devastating than dot-com bubble and 2008. The moment we got the DeepSeek crash on Monday, we have seen the biggest one-day inflow into the queues since 2021, buying the dip, because these zombies are just programmed to do that. They have no other idea on how to make money in the market but play the dip, play the dip. These stupid fucking donkeys. But they're going to get slaughtered. That's the good news. Another headline, small investors bought the dip in NVIDIA by a record amount on Monday. Small investors, once again, the insiders are dumping small investors, pouring $562 million buying the dip. You didn't really think about the narrative? DeepSeek, what does that do to NVIDIA's business? What does that do to the demand and the pricing power? No, they're zombified. They're brainless. There is no ability of critical thinking at all. That's why it's going to be really, really devastating this time around. Even one of the biggest wealth funds in the world, the Norway Fund, they've been long technology for a long time, making a record profit of $222 billion. They say that the boom will not last. So again, insider selling is at all-time highs. The big guys are secretly hedging and dumping. Goldman Sachs' elite clients are dumping, but the retail mom and pops are picking. That's the recipe for disaster, folks. Bubbles can be fun, but you gotta know when the music stops. You gotta know when to book profits and when to hedge. But the complacency here is so absurd that they don't even think they need hedging anymore. But again, unfortunately, we have an entire generation of investors. All what they know how to make money in this market is just to buy the dips. Time in the market better than timing the market. Yeah, let's see when you're going to recoup your losses. Maybe when you're a corpse. Time in the market is going to serve you. Me, I say fuck that. We're going to time the market. That's how we make money. Guess what we did? What we've been doing at the Maverick of Wall Street. Sure, maintaining long exposure. We got some stocks, got it. But we're hedging all the time. But from a trading perspective, here's the hourly chart of the SPY. We get the flush in December after the FOMC. I fire up the trade right away, buying the 585 puts because I'm exploiting the increase in gamma. We explain that to the viewers and the members all the time. Gamma walls. You break them, you got a gamma event, either a regular gamma or an inverse gamma. That's where the juice is. That's how you make the big bucks. So we get in and within, let's say, 30 minutes later, making a profit of over $100,000 or 266%. Then before the beginning of the year, right where I'm pointing right here, suggested that we go with the SPY 585, 575 puts, expiration date Jan 17, among many other trades that we've done. Well, guess what? After that, the market rallied a little bit, made a higher low, and then came back down exactly to the target that we had. Then comes where I'm pointing right here. Okay, we're going to get a rebound here, and has a little bit of juice into it, so let's go with some calls, and this is what we said. And let's do February. Yeah, you get about $500 worth of credits, so I'll take that. And depending on the close today, how we're going to trade, I'll probably go with next week's, once again, 605, and then buy the 600. Let's just see if we give it another week. Will it cost too much? Again, up to you. 215, 250. You're still going to have credit in your pocket from the puts that you sold, and you're going to have exposure to the upside. Got exactly to the target of 610, and after that, what do? We flip back to the puts. 600 puts, expiration date Jan 27th. It appeared to be a loser for a while. It was losing about 70%. But again, it takes brains and balls. That's the key word, balls, to get the job done. And what do you know? Then the market goes down. The trade works out, and we net a profit of over $75,000. Next, what do we do here? Market recovers again, but we say this is the time to hit it again. So comes Friday, and I suggested going with the 605 puts 0 DTEs, along with the 612 calls 0 DTEs, because I think there is a gamma phenomenon that's going to happen. Either both of them will work out, you book one when we go higher, then rely on the other, or one of them pays big and then you don't give a shit about the other one. But guess what? The 605 puts costing us about 25 cents a piece. At the end of the day, the pricing on that contract was over $5. So here we're talking about 2,000% worth of profits. We also nailed NVIDIA hourly chart. As you can see here, we got the bearish engulfing candle. What do? We went with 140, 135 put debit spread, expiration date 21st. We did a butterfly put spread, which ended up being a loser. But it cost a lot less than the put debit spread, and the profits from that one compensated for any loss from the butterfly. Bought it at 175, sold it at 420. NVIDIA goes down. Then what do we do on Friday's session? I say I got the NVIDIA 120 naked puts for next week. Closing that before the bell, paid about $2.89, closed it for $5. In, out, hello, goodbye. Steak and lobsters, baby. Here's a trade for you. Got in about 10.52, $2.89 limit price, 200 contracts, and we exited about, let's say, an hour later, 11.52, with a profit of about $42,000. And there are traders in Discord who made an insane amount of killing. So again, pretty pleased. When somebody says, oh, timing the market is better than timing the market, not in a bubble, baby. Maybe you should time the market. Because I'll show you here NDX, the dot-com bubble monthly chart. If you bought at the top of the dot-com bubble, you had to wait about 16 years to get back to even. The internet revolution was much, much stronger and had more merit than the bullshit AI revolution, which, by the way, the best thing that will come out of it is sex robots and nuclear annihilation, or not to mention some unemployment too. So all I got to say, folks, I'm doing you a favor here. Why don't you do yourself a favor and join us as a Maverick member so you don't miss on the action that we're about to get, because things are heating up. A lot of folks criticized this channel once we went private, semi-private. We still produce public videos. Maverick, you're greedy. You just want money and such. Well, I'm not going to spend 5 to 7 hours of my day making videos and content and then getting $50 in exchange. I'm not a factory worker in Bangladesh. This is a premier service kind of thing. White gloves, foot massages, happy endings kind of thing. Should cost you. But you want us to rely on YouTube, advertising money? Oh, hey folks, use this code. We're going to get 50% off of some dickhead service that I don't really believe in. Or rely on $50 from YouTube every day. Not to mention, of course, dealing with the stupid restrictions and the banning that they've done against us before. No thanks. The other thing is, this is a niche kind of service. To begin with, financial content is a niche. We're not doing Mr. Beast shit here to make millions of views. And we appeal to a smaller group of traders and investors, more mature. That's why the viewership is a little older here. Because we're not saying, oh, buy this stack, is going to make you a millionaire in 3 months. But when you have a niche service, it needs to be financed by the niche. Unfortunately, that's the way it is. But folks, we're giving you an opportunity in the month of February right here. If you want to join us, you can go to the links in the description and go to Patreon. You will find a promotion that gives you 50% off the first month, and then they round you up to the regular rate. If you like it, you keep it. You don't like it, you cancel it after 1 month. You can join us either in the first class, where you get the daily videos, the charts to watch series, the earnings review series, the options 101 series, and a limited access to Discord, which includes the lotto tickets, by the way. You can join us in the VIP tier. You get the first class benefits, plus full access to Discord, which includes morning briefs, option tracker, including the videos, live market chat, which we do an hour every day, sometimes more, the picture review series, which we haven't done so far, but we're going to do this year, where folks pitch ideas and I review them in a video. Steak and Pies video series, which we haven't done yet, but we're going to do, where folks share their experiences, trades that gave them steak, trades, investments that gave them pies, what we can learn from that. And of course, the stock battle video series, which we pin in 2 stocks or 3 stocks against each other. Figure out which one is the best one to buy or which one is the best one to short. And we're going to do in this series, of course, McDonald's versus Domino's Pizza. And because of the earnings that we got recently, we'll do Team versus Now, ServiceNow, and Snowflake and software. Then we're going to do Starbucks versus Dutch Bros. And after that, we're going to do Lockheed Martin versus Northrop versus Raytheon. And if you are loaded, you can join us as a Top Gun. You get the same benefits of the previous 2 tiers, plus 4 days we do live streams, and we do some highlights of these live streams. We do Q&A videos, and you get your name in the credits after each video. 50% off till the end of the month. Use it or lose it. Patreon, links in the description. And oh, by the way, this month we're running a promotion. You become a member, we give you free access to my OnlyFans. I post 2 feet pictures a day. My last message to anybody who criticizes me or says, Mav, you're greedy, you're superficial, you're narcissistic, is the following.
Now, if anyone here thinks I'm superficial or materialistic, go get a job at fucking McDonald's, because that's where you fucking belong.
Let's move on to the conclusion of this video. What do we have on the economic calendar tomorrow or this week? Beginning with tomorrow, February the 3rd, Monday, we got the manufacturing PMI. That's going to be important if there's any huge increase in the price indicator along with ISM manufacturing. We get construction spending and auto sales along with the speech by Atlanta Fed zombie Bostic. On Tuesday the 4th, we get jobs openings, factory orders, more speech by the Fed zombies. Then comes Wednesday the 5th, we have ADP employment, private sector of the economy. Then we get the services PMI, all eyes on the price indicator again. And per usual, of course, that's all what they do anyways. They're useless. The Fed zombies talking again and maybe selling some secrets to China, right? That's what they got caught doing. But Tuesday the 6th, we have initial jobless claims. We have U.S. productivity. And again, more Fed zombies talking. The most important day of the week, Friday the 7th, we get the employment report from the government. A lot of folks are saying maybe we'll see the real data now, that we have a new administration and the cooking maybe is going to be over. Who knows? We'll see. We get wholesales inventories along with consumer sentiment. You're reading from the University of Michigan along with consumer credit. On the earnings calendar, an important week ahead, we have Google and Amazon. The Nancy trade, will it be validated or not? In Big Pharma, we have Eli Lilly and Merck. We got McDonald's, we got PepsiCo, we got Disney, Philip Morris, Qualcomm, AMD. We have ARM, we have Amgen, Pfizer, Honeywell, Uber, Bristol Myers. We keep going. We got Spotify, we got PayPal, we got MicroStrategy, Chipotle, Mondelez. You get the deal here, folks. It's loaded with action. With that being said, folks, we ran out of time here. I don't want to make the videos too long, so we gave you the promotion. Join us, and we're going to do the technical analysis right after this video for the members. So join us to get that. We'll do a quick technical analysis, see where we stand. We'll look live at the futures. But for now, folks, for this video, this is all I got for you. Thank you for listening. Thank you for watching. I appreciate and love all of you. I'll be talking to you again tomorrow. Good night.
I keep